Welcome to Your Personal Bank Show, and I got to tell you what, wow, I've got a lot of stuff to share today. There's been a lot of exciting developments that have occurred in the last couple of weeks, and so I'm going to try to share some of that and just get a lot of information, kind of a machine gun approach maybe, if you will. Anyway, so the question I get all the time is this: what is your personal bank? Okay, really what your personal bank is it's a concept, it's a financial concept that combines the financial tools from both the banking and the insurance industries to create a positive arbitrage situation even when you access the funds to use for other purposes. So one of the statements I make a lot of the times is, how would you like to earn interest on money you spent? Now, you heard me right. Would you like to earn interest on money that you actually spent on things like, well, bills? We all have, pretty much all of us have, mortgages or other kinds of ongoing bills that we pay, car payments, whatever that may be. What if you want to pay off some debt? If you have some debt, that's always a smart thing to try to knock that down, obviously. What about investing in other assets? What if you could pick up 2 or 3% on your money while you allocated those dollars for those other purposes? You see, I'm going to go into this further, but I hope you guys got your attention, because one of the things I run into all the time is folks are, overly, I find in most cases, focused on appreciation or growth of their investments. And I'm not saying that's a bad thing. What I'm saying is the focus sometimes is to the exclusion, and maybe that's a better way of putting it, to other factors. See, there's a financial literacy wealth key. And it's pretty simple, and I think a lot of people that listen to this radio show probably understand this. I don't find a lot of people pay a lot of attention to it, but the reality is, how do you build wealth long term? One of my guests, John Burley, he was on in April, he talked about it. He's written a best-selling book and all that. I think he said it very eloquently when he said, he works with many, many millionaires and multimillionaires. He's one of the top real estate investors and teachers literally in the country. And he says, I know of nobody that didn't build their wealth long term over decades. And the thing is, by putting away a portion of their income over time. And the thing is, by putting money away, okay, you can grow the money, of course. That's important. But also how much goes out. The outflow is many times equally and sometimes more important. And to build wealth long term, really, it's quite simple. Your money has to grow more than you spend it, right? So in other words, you have to have more inflow or more growth than you have outflow. And very little attention a lot of the times is paid to the outflow side, the expense side. And that's where your personal bank, one of the areas where it can really shine. Obviously, it's a great diversification tool. I've shared that many, many times. Right now we have products right now that historically, actually, they're still paying over 6% and have so every year since 1996. And beyond that, actually. We've got companies that have never missed dividend payments in over 100 years, some of them even before the Civil War even. So in other words, they pay dividends through periods of time like the Great Depression without missing a beat. And like I said, even today, still paying over 6%. Now, I don't know about you, but in today's environment, with the low interest rate environment we're in, 6% is a pretty darn good rate, if you know what I'm saying. And so when you also calculate in there that it's tax favored, okay, now you're talking even a bigger benefit. I run into these folks all the time, every day, who, especially after COVID and all the stuff that's happened and the volatility and whatnot, have been looking at, safer money options. Safe money's become very popular recently. I'm sure most people understand that. I have probably never been busier in my career. I've been doing this for over 22 years, and this is certainly one of my busiest times in my career, no question. And people are looking for, that flight to safety. They're looking for an option where they can grow their money with some guarantees, with some downside protection, with some safety. Well, gosh, we can get them 6.1% tax favored right now. That's like I said, that's pretty darn good. The thing is, it even gets better. That's only part of the story. And so, like I said, when I said earlier, how would you like to get paid, or earn interest, I should say, on money you spent? I hope I got your attention, because this is something that's not talked about very often. And here's what I mean by it. Again, what is your personal bank? What does it really mean? It's actually a two-step process. The first step is we set up a high cash value policy that's established to maximize cash growth on a tax-deferred basis. Like I said already, we've got contracts that are currently paying over 6% and have every year since 1996. I can send you a spreadsheet, a chart showing all the top dividend payers since 1996. And you can show you the history of which companies have paid solid dividends every year consistently. I hear people talk about looking for interest, earning interest on bonds and dividend paying stocks. You hear about all those kinds of things, but many times fail to look at this as an option because, well, in most cases I find when I talk to people, they're just not aware of it. Again, many of these companies have been paying these dividends literally, some of them since before the Civil War, and consistently every year, and very quietly just going along and doing that. Hasn't been very well advertised. It's probably, I don't know the best reason why, but they're just consistently, steadily paying dividends every year. So if you're looking for a consistent return with some tax benefits, this is something you should consider. Certainly from a diversification standpoint, it makes a lot of sense too. But anyway, my point is real simple, is these are not the kind of policies that most people are familiar with. See, when we talk about insurance and life insurance and things like that, most people think of that in terms of death benefit protection. And this is one of my biggest challenges. In fact, this is why I do the show. This is why I do webinars and workshops and trainings and meet with clients and really to educate them. It's such a lost knowledge almost. It seems like it's so few people really understand or know that yes, insurance can be used as a death benefit protection tool, and often is and should be. And I always say, look, if you have a death benefit protection need, as I do, I have a family, I have a business, take care of those needs. And by the way, a lot of those kinds of needs can be taken care of in very inexpensively, as we all know, through term insurance. You can get it online even. It's a very inexpensive method of taking care of those death benefit protection needs. Businesses have them, key person, all those kinds of things. So it's used for very, very many purposes. But what I'm going to say is this. Well, most people that I talk to, and I deal with this on a daily basis, literally, are almost completely unaware that you can adjust these contracts to maximize cash growth, and the difference is significant. Okay? Again, the funds are designed to grow cash, okay? And the liquidity, have high liquidity day one. We have somewhere between 60 to 90% liquid day one if they're structured, depending on the situation, of course, and increasing to 100% liquidity usually within a few years, okay? The thing is, this is designed to build cash, to grow cash on a tax favor basis. The second step, which we're going to talk about more in the next segment, is we set up a line of credit with a bank using the cash in the policy as collateral. See, the principle of this is really not unlike a HELOC. A lot of people are familiar with those. If you have a HELOC on a property, for example, that's a home equity line of credit, for those of you not aware. It's a way to access funds, backup funds, or use some business people and real estate investors use those actively to build business, but there's no fees. You only get charged interest when you're actually using the funds, okay? So it's a great tool like I said, as emergency backup. We're using these bank line of credits. We're using the policy as collateral for those, and the interest is much lower in most cases than what you're earning, which creates a positive arbitrage. We're going to talk about that further in the next segment, so stay tuned.